Some words I want us to take note of are credit, credit card, credit score, credit report, credit worthiness. But before we get into those words, I want us to gear our mind to Proverbs 22, verse 7. And the King James Version reads, "The rich ruleth over the poor, and the borrower is a servant or slave to the lender." So, now that we have that out of the way, let us get into understanding the concepts of credit, credit card, credit score, credit report, and credit worthiness. Credit. Credit is the ability to borrow money or to access financial services, typically using a credit card or a loan facility. So, in order to have access to borrow money, you have to have some relationship. But in order to have a relationship, you're going to need a report card and you're also going to need a score. So that takes us now to the credit score. A credit score is a numerical representation of an individual's credit worthiness based on their credit history. It is used by lenders to assess the risk of lending money to an individual. So let us think about it. In order to have a credit score, you have to have a credit history which tells your credit worthiness. I hope that you're seeing that there's some disconnection taking place. So, in order to get money, you have to already have a history. So, if you're a new person having no history, you may have a challenge in having a credit score. Now, there has to be a report that is generated to present to us this number. So, that takes us to the credit report. The credit report is basically a detailed record of an individual's credit history, including information on their credit account, payment history, or outstanding debt. So if you don't have any credit history, which means that you have never borrowed money before, you have never been a servant to a financial institution, then you will not have this information. That means that you would not have a credit account, you would not have a payment history, and you would not have any outstanding debt because you are basing your availability of resources on what you actually possess. So you're only utilizing what you have in your possession, what you are able to lose. So that there puts us in a catch 22 because in order to have credit, you need to have a credit score. But in order to get the credit score, you need to have a credit history. But in order to have a credit history, to be on a credit report, you actually need to have debt. So this system is putting us in a conundrum, and that there makes it a challenge to get a credit card. Now, a credit card is a financial product. Yes, it is a product that allows an individual to borrow money from a lender up to the certain limit that is set, and they have to pay this back over time. So the credit card is there as a loan. So yes, it is actually you borrowing money to use in a particular period that you will have to pay back in a next period. And if you are unable to pay this money back, then you will have to pay what we call interest. Now, for the recap. So, the credit refers to the ability of an individual or a business to borrow money or to access financial services based on their perceived ability to pay it back. So, if you have $10 million and you have no credit outstanding, outstanding debt, you don't owe anybody any money, there is the hesitancy of persons to actually lend you money even if you have money. because you don't have a history. But in order to have a history, you have to have the ability to borrow. So that there is a challenge that many persons face when they are getting into this system, and that there makes room for the predators to feast upon the naive, the young, the innocent, because of ignorance. A credit card is a financial tool that allows the user to borrow money from a lender, typically a bank, in order to purchase or to withdraw cash. And even though you can withdraw cash, it is not advisable to withdraw cash from a credit card because that is going to trigger a cash advance fee, which is usually about 3 to 5% in some instances, but you have predators who can even take it up further, depend on the jurisdiction. And the interest is capped in some countries, but in other countries it can go up to 18, 90%. In Jamaica, one of the leading financial institutions currently have a 50% credit card, which would in America be considered a loan shark kind of territory. So we have to be very mindful and very vigilant as to the different interests that we have to pay. Credit cards usually have a credit limit. So basically, the credit card has a limit. So they will tell you, hey, you have $500 limit, or you have $50,000 in credit limit, which means that they will guarantee you that amount of money so you can take that loan and do whatever you need to do with it within that limit, and then you pay it back over time or over a particular predetermined time. And if you are not able to meet that deadline obligation, usually 25 to 31 days is the window for revolving credit. If you don't pay within that time, you'll have to pay interest on the money. Plus, if you miss the payment, you'll have to pay a late fee. And then guess what? That impacts the credit score. So there is a minimum balance that needs to be paid at the end of each month when one has a credit card. So a credit score is the numerical representation of an individual's credit worthiness based on the credit history. So if you don't have a credit history, you cannot have a credit worthiness score. But they will just generically give you a low score because you don't have a history. The standard score range from 300 in the United States up to 850 in this region, depend on where you are. If it is 300, that's bad. If it's 850, then that's a good territory. Credit score are used by lenders. They are used by landlords, which are still lenders because you're lending your premises, their properties. They're used by financial institution to evaluate the risk of lending money or extending credit to an individual. And for some strange reason, I don't know why it is that your landlord would need your credit report, but in some cases, they do need it in order to weed out persons who are not going to be able to pay the rent that is due. And you know that some states, some jurisdiction has more affinity towards being more overwhelmed by the renters in terms of the renters have more power than the landlords, so they have to mitigate against that risk as well in their investment or in their business. Now, the credit report. A credit report is a detailed record of an individual's credit history, including the information about their credit accounts. So, if you have a credit card, if you have a vehicle loan, if you have a mortgage, whatever accounts, the credit inquiries, which mean that if you try to get loan from bank A, bank B, bank C, all of that will be there. Your payment history. So if you had credit before and you had a good track record, that there is going to be on the payment history. And the payment history is usually some of the bad delinquencies usually drop off after about 7 years. But we don't want you to have any delinquencies on your credit report if you currently have credit cards and credit facilities. So credit reports are used by lenders and other financial institutions to assess your credit worthiness of you as an individual or a business if you are representing a business to see if the business will be able to pay back the money that has been granted to them or extended to them. Credit is the trust that allows you to borrow money or to access loans from a lender. So, credit is based on trust, and you have to understand why it has to be based on trust because the money that you're giving you doesn't really exist. So, it is a trusting relationship that I give you, you will give it back to me. And but the thing is, you are always as the borrower at a disadvantage because the lender can always write off the bad debts and get exemptions based on those written off debt. So even if you have delinquencies and creditors are calling you and they have sold your information to other facilities so that they can get whatever it was that was owed, they would have already written off that debt and they would have already been credited for that written off debt, but they are still sending someone to try to collect that debt because they had sold your debt to it is a system that is intertwined and interweb. But as the borrower, you are actually the servant because now you are working to pay them back. So am I saying that you should not have any debt? I am actually saying that it is better to go to bed not thinking about who you owe money. It is better to think about who owes you money and how you're going to get your money from those persons. Take it from me, it is better that way. All right. So, as much as is possible, I would advise people not to take out debt. And if you are the head, the word of God says to us that we should be the head and not the tail, which means that we should be the ones with the resources as Christians. We should be the ones helping people who need the resources. We are not the ones who should be trying to get that resource by these secularized methodologies. Credit is typically issued or extended in the form of a credit card, which many persons have and have hung themselves because of those credit cards and their balloon payments that they have to make and the monthly interest and the installments and all these burdens of fees upon fees. Or they may take a loan, yes, a loan such as a car loan, a vacation loan, all these loans. But the thing is, if you cannot afford it, do not go and get it. All right. And it is based on your credit worthiness, which is determined by the credit score and the credit report. So your credit worthiness is not necessarily a true reflection of your trustworthiness because you could be a trustworthy individual, but because you don't have any history that is documented, then you are denied credit. You are denied the opportunity to be in the financial operation where credit is being discharged. So, a credit card is a financial product that allows you, the borrower, to access money from the lender up to the limit to make purchases or withdrawal. So, credit card typically charges interest for unpaid balance, and this is where they make their money. They also may have annual fees, and you should stay away from annual fees. You should not even be paying interest on the money that you take from your credit card. In terms of the money you swipe on your credit card, you should not be paying interest. So you have to have the money before you even swipe that card. So balance transfer, if you transfer, you have a credit card that has a high interest rate and you transfer from one card to another card, they may charge you a 3 to 5% balance transfer, and some jurisdiction may charge you even more. And then they have other charges, late fee, they may have minimum balance fee, and all these kind of fee. So you have to be very mindful that you are actually setting yourself up in a prison when you are receiving a credit card, especially if you are receiving it in ignorance, because these financial institutions can be predatory, and that can jeopardize your whole financial plan for the future. And you don't want your financial plan to be jeopardized. A credit score is a numerical representation of your credit worthiness based on information in your credit report. So you have to have a report to have a score. Just like when you're going to a school, you get your different subjects or your different classes, and you have the different grades, and at the end of the day they give you the average, and then they calculate based on everyone else in that year group to see where you fall, whether you're first, whether you're second, whether you are last. So it's the same thing that the credit score system is based on. Now let us look at credit worthiness. So credit worthiness is a measure of a person's ability to pay back a loan or credit. It is determined by the number of factors, including the credit history. All right. So whatever you had before, whatever facility, whoever you borrowed money from, you borrowed something from in the past, and it was reported, because you can borrow money and it's not reported. So once it's reported, then it creates a history on your file. So your income as well determines how much money you can access. So the more money you make, the more credit they are willing to give you, because they are assuming that you have the ability to pay that back. And if they can do your DTI, debt to income ratio, and you have a low debt to income, then you are even getting more money available. Then your employment status, if you are employed, it means that you have cash flow coming in, and when you have cash flow coming in, that is encouragement to the financial institution to give you money. So yes, they want to give you money so that you are not only working with your employer, but you're also working now for them when they give you that money. So a credit worthy person is likely to be approved for loans or credit, while a person with a poor credit worthiness may be denied or offered less favorable terms. So if you don't have a good credit worthiness based on the credit scoring metrics, the number that they assign to you, you will have a lower score. It doesn't mean that you are less worthy. It just means that they don't see you as a fitting candidate for the resources that they would be given to others at a more favorable rate. So when they think that you are in a more, how should we say it, unfavorable position, then you will get exploited more, in which you'll have a higher interest rate, you'll have lower limits, and you will be in a bind with greater restriction as to how you can use the facilities that are assigned. The more money you have, the more people want to give you money. It is like the principle where money attracts money. And many people will realize that the more money you have, the more money you get. And it's easier for you to embrace this belief and this system, because this is how the world and the money flow system work. That is why the rich will always become richer, because money attracts money, and the perception of money also attracts money. Credit history is an important determinant factor in determining your credit worthiness. It includes the record of a person's borrowing and repayment history, as well as any bankruptcy, because a lot of persons bite more than they can chew. All right. and they may get into difficulty in which they have to file for bankruptcy. So lenders use this information to assess the risk of lending to a person, and a strong credit history can help to demonstrate that the person is reliable and responsible with money. So they want you to be responsible with money so that they can give you more money. But if you were responsible prior with other people's money, you will be responsible with their money. But why not just be responsible with your money? That way you don't have to borrow other people's money and then have that burden over you. So you can't even sleep good at night because you're thinking about repossession. You're thinking about having to go to a job that you don't want to go to just because you have to pay these bills. Income is another important factor in determining your credit worthiness. Lenders want to see that the person has a stable income that is sufficient to make or to meet that requirement of payment of the loan or the credit that has been extended to them. This helps to ensure that the person will be able to pay back the money that they borrowed. So if you took a loan, you had a job, and then you lose a job, you still have the loan, right? So it is helpful to the lender at the beginning, but during the process, it's no longer helpful because things and circumstances can change. And that is why they always want to see the history, employment history coming into the mix as well. But before we get to the employment history, debt is also a factor in credit worthiness. A person with a lot of debt may be considered less credit worthy than someone with less debt, as they may seem as less able to pay back the credit. But let us think about it. The reason why you get a loan facility is to probably clear debt, but they want to give you money when you really don't need the money so that they can make money from you. So you have to know what is in your best interest if you are going to take on debt upon yourself and become a slave to a financial institution. Your employment history can also affect your credit worthiness. A person with a stable employment history is generally considered more credit worthy than someone who has had frequent job changes or gaps in employment. So they don't like when you move from job to job, even if the job is paying you more. They want you to be constant or consistent. But the truth be told, it varies from person to person. Some persons will move from job to job, other persons will stay in one job, and they are in that job not because they need to be in that job, but because they just want to get a particular access to a particular loan facility. But usually people, after they get that loan facility, they just get up and move to another deployment or employment opportunity. So it is beneficial on the front end, but in the middle and on the back end, it is not giving a good indicator in the long run. Overall, credit worthiness is an important factor in determining a person's ability to borrow money and to access credit. It is important for people to manage their credit and financial affairs responsibly in order to maintain a strong credit worthiness. And let me let you know that you can actually borrow money without even having a credit score. There is something called the manual underwriting, but most persons are too lazy and just want to put everything in a system, a database, and give you an answer. You know? Yes, but in summary, credit cards, credit score, and credit report are all related to borrowing and lending money, and they are all used to assess credit worthiness and financial stability. So just as our companies exist and we go through the balance sheet, we go through the financial statements, we go through all these records to see if they are a viable company before we invest in them. It's the same system that exists when other persons are looking in. They want to see your household financials so that they know if you are in a position to meet your debt obligation. So you cannot want to expect X from external companies, but your internal company, your household, that as a man you should be leading, and the woman should be managing. But if you're a single man, then you should be the leader and also the manager until the woman comes to manage the resources that you have, and she multiplies them because she is now helping you to achieve the vision that God has impressed upon you. So these are some things that we have to take into a consideration. So when we talk about credit, credit card, risk assessment, risk management, we have to talk about credit management. So credit management refers to the process of managing and using credit in a responsible way, and efficient way, and effective way. This include understanding credit. All right. This can involve applying for credit cards, loans, or other forms of credit. When applying for credit, it is important for individuals to shop around. I know that many persons may still desire to be a slave, but that is not what we are presenting to you. We don't want you to be enslaved. Some persons are already shackled by credit, so we are just going to give you guidance as to how you can get out of the debt cycle so that you can become financially free. Because there is joy in freedom. So if you're going to try to get a credit facility to get out of the credit bind that you're in, maybe you get a 0% interest credit card to clear off the balance that you have, so you buy yourself a little time. You have to shop around for the best rates. You don't want to take the low hanging fruit. And if you get a low limit credit card, that the lowest limit credit card you have impacts the other organization ability to give you money, because they're saying that they gave you $500 credit limit, they want to give you 5,000. They are not going to give you the 5,000 because you have that 500 limit on there. So you have to try to increase your credit limit so that you can get access to more credit. And sometimes you just have to cut off the low limit cards. If they are not increasing your limit, just cut them off and call it a day. And yes, it will impact your credit history, especially if this was one of your first cards that you have. So the more predatory banks or financial institution will give you low limits and keep you in that there for an extended period of time, which will jeopardize your ability to get access to actually good credit lines. So you have to know and weigh the balance to see what is in your best interest. Using credit wisely, once you have obtained credit, it is important for you to use it wisely and responsibly. This means that you'll pay your bills on time, you'll keep your credit balance low. Usually, 10% is the area that we want to, 0 to 10% is where we want to keep it at the end of the statement cycle. So we don't want to get it up to 25% because 25% is the next tier, but anything above 25%, that there is over leverage situation. All right, so we're going to try to keep it to 0 to 10%. And taking more credit than you can afford to pay back, that there is a setup for a disaster unless you are strategic and you're going to be doing a rotation of your credit. You're moving from one to another, you're transferring money, and you're not incurring those charges or those fees. So monitoring your credit score, because sometimes, especially in America, people will open credit cards on your behalf without your permission or consent because they have taken on your identity. So this is a practice, stolen identity. So you have to monitor your credit. They will even change your address so that the credit information is sent to another address. You have to be very mindful because your data is constantly being bought and sold on the web and on the black market or the dark web. It's a good idea to monitor your credit regularly to ensure that your credit reports are accurate and that you are not a victim of identity theft. You can get a free copy of your credit report from the three major credit bureau, which are the Equifax, Experian, and TransUnion, once per year. All right. So if that is important to you, then you can do that. Or you can just, when you apply for credit and you are going to receive credit, they also give you an indication of what your credit score is. So if they deny you credit, they also tell you what your credit score is, what are the reasons why they denied you the credit. So you can use that paper and know what your credit score is at the current time, and also the reason for the denial. Now, paying off debt. If you have outstanding credit card balances or other debts, it is important to make regular payments, not only regular payment, but make on-time payments to pay off the debt to improve your credit score and your financial stability. The aim of our interaction on the Dr. Kareem Ainsley encounter is for you to be in a financially stable position so that you can have financial peace. And when you have financial peace, you can move into financial prosperity. And that there is where the financial freedom comes in. So by following these steps, you can effectively manage your credit and use it to your advantage. It is important that you remember that the credit is just a tool, and like any tools, if it's not used wisely, then it may be misused, which makes it useless. By using credit wisely, you can build a strong credit history and a financial foundation if you are in that realm or already in that realm. But what I want us to consider, though you may be in this realm of having credit card, I want you to consider how can you become so free that you have no longer a need for credit cards, you don't have a need for loan facilities. You can now live a life in abundance where you have financial freedom. So that is where I want you to put your mind so that we can get into the stage of how we are going to get out of debt. When it comes down to money, I want you to understand what principal and percentage rate means. So the principal, this is the initial amount of money that the borrower, or the initial amount of money that is invested. So it's either the amount of money that is borrowed or the amount of money that is invested. And the annual percentage rate, or the APR, is the annualized interest rate that is charged on a loan or credit card, including fees or other additional costs associated with borrowing the money. All right. So credit can work in two different areas. In credit, you can be the borrower or you can be the lender. When you are the lender, you are considered the investor because you are getting the interest. When you are the borrower, it means that you are paying the interest, which is going to the investment of the lender. So you have to decide which side of the spectrum you want to be. You want to be the slave or the servant, or do you want to be the master, the ruler, the head, as the word of God indicates? Some other key concepts I want us to bear in mind are saving, budgeting, and emergency fund. Each individual needs to just have an understanding of these concepts. So saving is a type of account that is allowed for deposits to be placed in. Budgeting is basically a method of structuring the money that is coming in and ensuring that they are assigned to where they are going to have their outflow. All right. And then the emergency fund is a fund that is set up with money saved is for specifically unexpected situation or expenses or emergencies. So those three things are very important for us to know. So when we talk about saving, a savings account is typically a financial product. Yes, I keep using the word product because when you go to the bank, they are actually selling you something. They are selling you a checking account. They are selling you a savings account. They are selling you a credit card. They are selling you loans. They are selling you all these investment opportunities. They're actually presenting that is their product, right? So yes, a savings account is a financial product that allows you to deposit and save money in a bank or a credit union or a community facility. A savings account typically offers the lowest form of interest rate than other types of investment accounts. When we say the lowest form, we mean that it is negligible. We don't mean that it's like the lowest, like there's no other account that provides lower. Because checking account sometimes provides equal to a savings account. So you just have to shop around for the best rate, and different areas, different jurisdiction may even have negative interest rate. So we have to be very mindful of where the money that we have or acquire is being parked. So saving refers to the act of setting aside a portion of your income or your inflow or the cash flow for future use rather than spending it in the present. But saving, the idea of saving is not that you're not going to spend it. The saving is for the purpose of spending or for keeping the money cycle or the money flow going. But it's just to amass a particular amount to spend on a particular endeavor. All right? So money that you want to spend, you're actually saving first to amass it so that you don't have to take a loan against the money. But different persons have different teachings, and yes, it is easier to advance your wealth by taking loans and taking more risk. But each person has to decide whether they want to follow the world standards or whether they want to follow God's standards. And that there now is dependent on you and your relationship. To have a financial cushion is one of the reasons for saving. To pay off large purposes is also another reason to have a savings, such as you want to pay off your house, you want to buy a brand new car. All of these are reasons for saving. To achieve your financial goal, you want to retire, you want to send your child to college, you want to do something special for someone, that there is another reason for saving. If you want to have financial freedom, and to make decisions without looking back. People may save for those situations, but there are other ways to get and achieve all of this. Some persons save in a bank, some persons save in investment account, such as the 401k, the IRA, or the other investment vehicles. But we want you to realize that saving and investing are two different ball games, right? So savings, you have access to your cash or your liquidity is available. But with investment, your liquidity is not readily available. You have to wait a period for the money to be cleared, and then you have to deal with the possibility of taxation or the restriction as to when you can actually access your own money. So all of these has to be taken into consideration when we're talking about saving and investing. When it comes on to saving, it is generally recommended that you save a few dollars each month, but you have to determine what your goals are and what it is that you need to achieve. So every single dollar that you make should have an allocation. So if you make $100,000, the $100,000, every single dollar should have an allocation. So at the end of the month, you should have zero unallocated funds. All right. So there are several different types of savings account. You can choose whichever you desire. You have the traditional savings accounts, which is basically putting your money in the bank so you can draw it out at the ATM. Then you have the high yield savings account, which has better interest rate. In 2024, you may get 5% on your money. Then you have money market account, which you could say gives a higher rate of interest than the traditional savings account, but not necessarily than the high yield saving account in at this time. You can do this month to month. Then you have certificate of deposit, which should give you a higher rate of return than the high yield savings account. However, your money is basically locked up for a fixed period. And then there's this penalty if you take your money out prior to the time of the lock-in being completed. Then you have your online savings account. So there are many different ways that you can save money, but all your money should be allocated for a specific purpose. Now, budgeting. Budgeting is basically a plan for managing your money, which including your incomes and your expenses. Yes, I said incomes, which means that you should have more than one source of income. But if you have one, that's a good place to start. If you have zero, you need to get one. And when you get one, you need to multiply to get more than one. So because one is too close to zero. And if you are in a state where you have no cash flow coming in, then you are running the risk of increasing your burn rate, because now you can be taken advantage of. And we don't want you to be in a state where you are taken advantage of. A budget is a financial plan that outlines how you will allocate your income and expenses over a period of time, usually the month. Creating a budget can help you to manage your money more efficiently and track your spending. I want you to track your spending. So remember, we want to allocate every single dollar that we have, so we know where every single dollar is going. And when we know where every single dollar is going, then we can tell the dollar what it needs to do. And if it's not performing, then we can just take it back and put it where it will be performed. Remember the story of the man who went on a journey, and he had his servants and he gave them the different talents. The ones that multiplied, they got more. The one that didn't decide that multiplication was in his vocabulary, that was taken away. So it's the same principle that applies to your money. So the Bible has been teaching us all this time about managing our family, managing money, managing our health, but we have been oblivious to that which was right in front of us. So, yes, we have to exercise proper stewardship as we move forward into being a representation of God's ideal. So, to create a budget, you will need to determine your income. So everything that you get money from, or you garner money from, you have to indicate that everything that you spend the money on, your expenses, whether they are fixed, they have to be included. Your variable expenses have to be included. So your groceries, your utilities, your transportation, your cost of debt. So if you have debt payment, that there now comes as an expense to you. So all of these things have to be factored in. So once you have the income and you have the expenses, then you can allocate each of those, and then you subtract your income from your expenses, and then now you can decide where you want to increase and decrease and make adjustments as needed, so you can actually see where your money is going, and then you can do your percentage calculation so that you can have a visual graphical representation of your inflows and outflows. When we talk about the emergency fund is a fund that is set up. It's like a savings account, but it's like a maybe 3 to 6 months emergency fund, maybe a year. It all depends on what amount of money you think that you'll reasonably need in order to accomplish the vision that you have been given. So the emergency fund is set up with a specific amount of money that can last for a specific amount of time, just in case there's an unexpected emergency that comes. So say for instance, you may have lost your job. You have a 6 months grace period where you can use what you have, live off that, and still not be in a position where you are destitute, right? So you have that set aside just per adventure. So an emergency fund is a specific amount of money that is set aside for an unexpected or a financial emergency. Yes, and it should only be used in the case of an emergency. So you'll have your emergency fund, and usually I encourage people to put your emergency fund in a high yield savings account, because you can access an high yield savings account funds just as though you can access your debit and your 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 debit card, your debit money, or your money in your checking account. So you can just transfer it from your high yield savings right back into your checking account within seconds. So and the high yield savings account give you a higher rate of return than your savings account. So I would suggest that you go straight into your high yield savings account with your emergency fund. All right, and then all your other money will be allocated to your different investment, to your different goals and objectives, and then you tackle them one by one. But you have to have a vision, you have to have a plan in order to be able to execute them and know that you are being successful or unsuccessful. So an emergency fund is a specific amount of money that is set up for an unexpected expenses or financial emergency. It is generally recommended to have an emergency fund that is equal to 3 to 6 months of your living expenses, although the exact amount will depend on the individual circumstances based on what you actually use, the cost of living is in the area, how much you are actually earning. So having an emergency fund can provide a financial security and help you to weather unexpected financial challenges such as a job loss, medical expenses, natural disaster. It can also help you to avoid taking on additional debt such as a credit card, uh, or a same day or payday loan. To build an emergency fund, you have to set aside a small amount of money from each of your paycheck, or to set up an automated method of transferring money from your checking account to your high yield savings account at a particular point in time in the month, so you don't see the money, because some persons, when they see the money, they want to spend the money, and that there is a problem. In general, it is recommended to use your emergency fund only in the case of a true emergency. So we don't want you to create an emergency just because you want to tap into the funds. Just let the funds sit there, and that will give you the peace of mind to live with less stress and anxiety as you take your time to build, and you take your time to strategize and determine where you want to be in the future. Remember, in order to get anywhere, you have to have a plan, because if you don't have a plan for your future, someone else will have a plan how you can be instrumental in helping them to achieve their future goals and objective. So, with that said, I hope that you will be adequately positioned to use the resources that God has given you, so that you can be a steward that is representing God in His glory. Until next time.